Thanks for your interest in International Tax course videos. If you'd like to purchase the entire course, click the link in the description. If you're watching this on mobile, you can click the downward arrow here and it will show you the link to purchase the entire course. Now, as you start your studies around international tax, one of the very basic but of the most important provision is how does the provision of the Act interplay vis-a-vis the provision of the treaty. So there are certain provisions in the Income Tax Act as well which deals with the taxation of non-resident. At the same time, there will be certain provision in the treaty which may deal with the same income as is dealt with in the Act in the treaty as well. Now definitely if the provision in the treaty were to be the same as they are in the Act, there was no need to have the treaty itself, right? In such a situation, which provision should be dealt with, which provision should have preference over the other, that is something which is governed by the provision of section 90 subsection 2. What this section says is where the central government, and the central government here refers to the Indian government, has entered into an agreement, right? Agreement is what? Agreement is the reference to the double taxation avoidance agreement which we are referring to here as the treaty. Where the Indian government has entered into a treaty with the government of any country outside India. So let's say whether it is be US, Mauritius or any other country's government, right? Or specified territory outside India, right? As the case may be, under subsection 1. Subsection 1 here refers to section 90 subsection 1, right? So where the Indian government has entered into an agreement with the government of any country outside India or any territory outside India under section 90 subsection 1 for granting a relief of tax. What is the agreement for? The agreement is to provide relief of tax. Now, relief of tax would be in a situation where, let's say for example, there is an Indian company. It derives income from a foreign country where it has paid taxes, right? Now, if the Indian government taxes it again, there will be double taxation. So the Indian government may actually provide relief from Indian tax on such income which has suffered tax in the foreign country. Or as the case may be, avoidance of double taxation, right? The same example that I gave you, if Indian government were also to tax that income which he has received from the foreign country, there will be a double taxation. Then, in relation to the assessee to whom such agreement applies. Now, one thing which is important and which comes out from this particular word is that the person or the assessee who is eligible to take benefit of such an agreement, which is referred to here, is the one who is able to claim the benefits under the treaty. First and the foremost important part is that the assessee who claims the benefit under this treaty should be covered within the provision of that agreement. Generally, these agreements are applicable to residents. Okay, I know the presentation is not that clear for this word, but the agreements are typically applicable to resident of a contracting state. Then in relation to other assessee, such an assessee who is covered under the provision of that agreement, the provision of this act, which is the Income Tax Act, shall apply to the extent they are more beneficial to that assessee. What this means is that if the provision of the act are not beneficial to the assessee, but the provision of treaty are beneficial, more beneficial, right? Then the provision of treaty will apply. But if the provision of the act are more beneficial, then it is the provision of the act which shall apply. Now I'll give you an example here that will cover this. So let's say, for example, the withholding tax under the treaty is 25%, right? And under the act is 30%. I'm just giving an example. In such a case, the provision of the treaty which provides for a withholding tax of 25% are more beneficial, and the assessee can opt for such provision. But if instead of 30, the withholding tax under the act was 10%, then the provision of the act are more beneficial, right? So the provision of the act shall apply to the extent they are more beneficial to the assessee, right? The thumb rule is, if you deal between the act and the treaty, whichever are more beneficial, that is what shall apply to the assessee.